Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. I want to note for the record that due to the COVID-19 pandemic, today's meeting is open to the public through a live webcast only. The public may access the meeting by visiting the agency's homepage at www.ncua.gov and clicking on the provided link. I would also like to note that participants in today's webcast meeting are participating remotely. So if we experience any technical difficulties, I ask for your patience. Before we begin today's agenda, I, along with the other board members, want to recognize International Credit Union Day. Launched in 1948, International Credit Union Day is a time for credit unions, financial cooperatives, their regulators, and other organizations around the world to recognize the global impact of the credit union movement. This year's theme is Building Financial Health for a Brighter Tomorrow. In the spirit of this theme, and consistent with the purpose of the credit unions outlined in the Federal Credit Union Act, the NCUA is pleased to join efforts to recognize the importance of credit unions and their unique structure as not-for-profit, member-owned financial cooperatives. While credit unions work to strengthen the financial lives of individuals, families, and businesses in the communities they serve, the NCUA is working to protect credit union members and reinforce credit union efforts to ensure access to fair and affordable products and services. At 2 p.m. today Eastern Time, the NCUA's Office of Consumer Financial Protection will host a virtual event, Pathways to Save and Affordable Account Access to Consumers, to highlight how credit unions are providing safe, low-cost, low-fee transactional and savings accounts that promote financial stability and well-being. I encourage anyone who is interested to participate. And as the economic fallout from the COVID-19 pandemic continues and many relief programs come to an end, the NCUA continues to encourage credit unions to work with their members and act proactively to help them prepare for how to respond to their members' financial needs. The NCUA and credit unions must stay focused on addressing the unique needs of these households, and I hope that by next year's International Credit Union Day, we will have seen the last of the pandemic. That concludes my remarks. Vice Chairman Hauptman, would you like to comment?
Yeah, I'll just briefly mention that credit unions are international, and like a lot of things in America, they were brought to us from immigrants. I believe the first credit union in the United States were Quebecois mill workers who came over the border to New Hampshire and replicated the credit union they had back in Quebec. And all I'll say is I like to think that if those folks could see what have happened today, they would be pleased with the result of their work. That concludes my remarks.
Thank you, Vice Chairman Hauptman. Board Member Hood.
Thank you, Mr. Chairman, and good morning. I would certainly like to wish everyone a happy International Credit Union Day, where we all are gathering you all under the umbrella of building financial health for a brighter tomorrow. And who better than our cooperative spirit of credit unions to lead this charge? I am so delighted that credit unions all over the globe are embracing a lot of the tenets that we've been talking a lot about here in the United States, and that is greater financial inclusion and giving underserved, marginalized communities access to capital so they can have agency in their lives and their families' lives. I am especially pleased, you all, that our credit union system in America, where we now have over 127 million members, are a part of that global community of now roughly 375 million credit union members throughout the globe. And whether I meet with credit unions from Africa that are called SACCOs, or in the United Kingdom that are called building societies, or cooperativas in South America, at the end of the day, it's that collective spirit of working together to provide great services and hope for the member-owned cooperatives. So happy International Credit Union Day. And Mr. Chairman, I'm delighted that we get a chance to give comments about how we all as a board support this great international movement. That concludes my statement.
Absolutely, and I think you make a really good point about 375 million credit union members worldwide. I mean, there are 125 million in the United States. That's 1 in 3 worldwide members, and it's remarkable to see how the cooperative credit movement has taken root and really blossomed in our country. Now, let's turn to the first item on our agenda, a cybersecurity board briefing. Staff presenting, Ernie Chambers, Critical Infrastructure Division Director, Office of Examination and Insurance. Staff available for questions, Tim Sagerson, Deputy Director, Office of Examination and Insurance, and Joy Lee, Associate Director, Office of Examination and Insurance. Ernie, you may begin when you are ready.
Good morning, Chairman Harper, and thank you, Vice Chairman Hoffman and Board Member Hood. It is my pleasure today to present the semi-annual briefing on cybersecurity. Next slide, please. The topics I will cover today include the Cybersecurity Threat Update, Information Security Examination and Cybersecurity Assessment Program, Guidance and Risk Alerts, the Cybersecurity Resources webpage, and finally, some industry outreach and partner engagement activities. Next slide, please. We remain deeply concerned about the threat environment. The COVID-19 pandemic has indeed exacerbated cybersecurity exposures for federally insured credit unions. Ransomware, business email compromises, and supply chain vulnerabilities are some of the ways that cyber criminals exploit vulnerabilities within the credit union industry and the broader financial system. At this time, I would like to briefly address each risk type. Next slide, please. Ransomware cases are continuing an upward trend and, according to the Verizon Data Breach Investigations Report, account for 10% of all breaches. The Financial Services Information Sharing and Analysis Center, FS-ISAC, identified ransomware alongside phishing and supply chain attacks as the largest cybersecurity threat of concern to its members in 2020. And these remain universal threats, regardless of member size or location. Cyber actors have adopted the new tactic of stealing the data and publishing it instead of just encrypting it. Cyber actors, often organized cyber criminals, monetize the theft by threatening to publicize the data unless a ransom is paid. The monetization of proceeds is typically enabled by cryptocurrency in an attempt to conceal the destination of proceeds and hamper the ability of law enforcement to locate and apprehend those responsible for the crime. Ransomware actors target at the enterprise level, enabled by the commodification of malicious code and the ransomware as a service model that lowers the barriers to entry, providing an increased number of threat actors with the capabilities and access to conduct attacks. Ransomware attacks continue across all sectors and have left organizations without the data to deliver critical services. Next slide, please. Bad actors continue to exploit third-party providers of IT services. Credit unions are increasingly using IT service providers to more cost-effectively support their operations. Credit unions need to use third parties as part of a competitive platform of services for their members. However, these partnerships carry an added risk that can challenge institutions, especially smaller credit unions. The growth of outsourced relationships can expose an institution to second, third, or even fourth-order risk, as their partners may also be using third-party providers that are interconnected. A credit union's third-party due diligence program will continue to grow in importance as the complexity of delivering financial services continues to grow. The FS-ISAC's 2021 Annual Cyber Threat Review asserts that third-party supply chain risk will dominate the threat landscape discussions. Next slide, please. Now, don't be alarmed by the overall numbers reported on this slide, as they are adjusted for losses and applied to the industry in general and not credit unions specifically. That said, in 2020, the FBI's Internet Crime Complaint Center received 19,369 business email compromise complaints, with adjusted losses across all sectors amounting to over $1.8 billion, compared to more traditional malware-based cybercrime, where threat actors must acquire access to malware, distribute it, and then harvest and exploit stolen data. Business email compromise attacks represent a profit-making opportunity that is comparatively low risk with a high rate of return on investment. There have been numerous reported cases of business email compromise with credit unions combined with account takeovers. This has happened largely through the use of well-known tactics such as phishing and social engineering. The risk of business email compromise can be significantly reduced by using more stringent access controls, such as multi-factor authentication for all critical accounts like the credit union's correspondent account. We are likely to see the emergence of more cybercriminal threat actors taking advantage of this type of threat. Credit unions are being encouraged to take steps to prevent this type of fraud and should report any incidents of fraud immediately to the FBI's Internet Crime Complaint Center or local field office. Next slide, please. Cybersecurity is one of the agency's supervisory priorities, and we continue to enhance credit unions' cybersecurity resilience through ongoing improvements to the examination program and by providing credit unions with guidance, information, and resources, ongoing monitoring and adjusting of internal controls, risk management practices, and risk mitigation strategies that adapt to the increasingly complex technology infrastructure and cybersecurity landscape are critical to our continued development of an NCUA Information Security Examination Program, a program that ultimately includes both a cybersecurity maturity assessment and an information security examination. We piloted Intrex CU for 18 months and continued and obtained regional feedback for improvement. Based on the results of the pilot, we identified areas for improvement with Intrex CU and are working with the regions to rebuild the program to be scalable according to the institution's complexity and asset size. We plan to provide training and testing of the program through June of 2022 and finalize for rollout in September of 2022. Next slide, please. The ASET toolbox contains the NCUA's downloadable application developed by the NCUA in conjunction with Idaho National Labs. The NCUA's ASET Cybersecurity Maturity Assessment Tool is modeled after the Department of Homeland Security's Cybersecurity Evaluation Tool, which provides access to industry-specific cybersecurity standards and other functionality. Next slide, please. The ASET Maturity Assessment mirrors the Federal Financial Institutions Examination Council's FFIEC Cybersecurity Assessment Tool and is designed to assist credit unions with the identification of cybersecurity risk while helping them to measure their cybersecurity preparedness. The assessment provides a framework for analyzing cybersecurity vulnerabilities associated with a financial institution's overall control system and information technology architecture, as well as a means for the user to document a process for identifying cybersecurity vulnerabilities. The new tool is an automated, scalable, guided approach and is mapped to recognized cybersecurity frameworks like that of NIST. We designed this tool to help credit unions manage cybersecurity risk effectively and affordably, and to provide a broad range of options for credit unions. The tool is free to download and will be made available later this month. It will be easily accessed by visiting the NCUA's Cybersecurity Resource webpage at ncua.gov/cybersecurity. Next slide, please. The Information Security Examination Program is the second element to the NCUA's Information Security and Cybersecurity Assessment Program. This examination supports a risk-based approach to performing information security reviews. It ensures both compliance with applicable laws and regulations and safety and soundness. The NCUA Information Security Examination Program, currently in development, will scale to the size and complexity of institutions. The objectives of the Information Security Examination include evaluating management's ability to recognize, assess, monitor, and manage information systems and technology-related risks, assessing whether the credit union has sufficient expertise to adequately plan, direct, and manage information technology operations, determining whether the board of directors has adopted and implemented adequate information technology-related policies and procedures, evaluating the adequacy of internal information technology controls and oversight to safeguard member information, and evaluating the adequacy of controls relating to privacy of consumer information. Next slide, please. NCUA continues to provide information concerning cybersecurity risk areas through guidance and risk alerts, all of which are made available through the soon-to-be redeployed Cyber Resources webpage. Most recently, in collaboration with the FFIEC, NCUA participated in the development and issuance of authentication guidance, which highlights how multi-factor authentication effectively mitigates risk while underscoring weaknesses in single-factor authentication. On November 3rd, the FFIEC will host a webinar to provide an overview of the new FFIEC guidance on authentication and access to financial institution services and systems. This new FFIEC authentication guidance sets forth examples of effective authentication and access risk management principles and practices. Additionally, the FFIEC issued a new booklet in the FFIEC Information Technology Examination Handbook Series titled Architecture, Infrastructure, and Operations. The booklet provides examiners with fundamental examination expectations regarding architecture and infrastructure planning, governance and risk management, and operations of regulated entities. The FFIEC will host an industry webinar scheduled for November 3rd, which will provide an overview of the changes and content of the new booklet, which provides expanded guidance to help financial institution examiners assess the risk profile and adequacy of an entity's information technology architecture, infrastructure, and operations. Next slide, please. As I mentioned briefly, the NCUA is revamping and later this month redeploying its Cybersecurity Resources webpage. The webpage will provide additional cybersecurity resources for research and informational purposes. It will contain references to NCUA regulations and guidance, requirements and guidelines, information sharing, and best practices. The Automated Cybersecurity Evaluation Tool, ACET, will be hosted and accessed from this web location. Next slide, please. Finally, there are several planned industry outreach events scheduled between now and the first week of November. These and other events like them will be posted to our Cyber Resources webpage, as well as announced via NCUA Express. Of special note, a webinar detailing the latest features, system requirements, and instructions for using the Automated Cybersecurity Evaluation Tool, the Cybersecurity Maturity Self-Assessment, is scheduled for October 28th. Additionally, in conjunction with National Cybersecurity Awareness Month, the NCUA's Cure Office hosted a Supply Chain Vulnerabilities and Cyber Hygiene webinar, which it held on October 14th. Some other useful webinars to consider are the Automated Cybersecurity Evaluation Tool webinar just mentioned on October 28th, Authentication Guidance webinar November 3rd, and the Architecture, Infrastructure, and Operations webinar also on November 3rd. Next slide, please. Once again, the Cybersecurity Resources webpage will be easily assessed or accessed from the link shown in this slide commencing the 28th of October. That concludes my presentation. We would be happy at this time to answer any questions the board might have.
Ernie, thank you for providing the NCUA board with a very informative briefing about cybersecurity issues. I understand that this is your first board meeting at which you are participating, so welcome and job well done. Joy and Tim, also thank you for being available to answer any questions. Like my fellow board members, I remain deeply concerned about the risks that cybersecurity poses to our financial system. As Ernie and others have noted, the COVID-19 pandemic has increased cybersecurity exposures for all, including federally insured credit unions. To that end, the NCUA is committed to maintaining the resilience and the readiness of the credit union system in responding to evolving cybersecurity risks. In that regard, the NCUA continues to mature and strengthen our cybersecurity program. As we mark National Cybersecurity Awareness Month this October, each of us, the NCUA, state supervisory authorities, vendors, and credit unions, has a responsibility to protect our systems, improve our ability to recover from incidents, educate our staff, share information, and report and address potential vulnerabilities. Phishing, ransomware, and distributed denial of service attacks are some of the many ways that cyber criminals exploit vulnerabilities within the credit union industry and the broader financial system. In order to raise awareness about the importance of cybersecurity, promote cybersecurity best practices, and inform credit unions about the potential threats they face, we are having this briefing today to receive updates on cybersecurity threats, the NCUA Information Security Examination and Cybersecurity Assessment Program, cybersecurity guidance and risk alerts, the cybersecurity resources page, and industry outreach and partner engagement. To compete, credit unions must be able to safely and securely use technology to deliver member services and adopt financial innovations to ensure the industry's long-term success. We therefore must all work together to promote innovation with an emphasis on security and equity. I encourage credit unions to utilize the information sharing groups and other resources presented during this briefing. Ernie, I now have a few questions for you. First, what are the 3 most important actions that a credit union, especially a small credit union with less than $50 million in assets, can take to maintain its cyber resilience? Which resources should they leverage?
For the record, sir, this is Ernie Chambers. Thank you for that question, Mr. Chairman. In a rapidly evolving budget-constrained environment, we recommend smaller institutions with limited resources and expertise implement the following. First, the ASET tool. The ASET tool guides users through a step-by-step process to collect facility-specific information addressing topics such as hardware, software, administrative policies, and user obligations. It then compares that information to relevant security standards and regulations, assesses overall compliance, and provides appropriate recommendations for improving one's cybersecurity posture. Second, we encourage credit unions to both learn and practice good cyber hygiene. Some sources for gaining a better understanding of good cyber hygiene practices are the NCUA's Cybersecurity Resources webpage, accessible from the ncua.gov/cybersecurity link. The Cybersecurity Resources website contains numerous links to key references and resources on cyber and cyber-related topics. Next, sir, the Department of Homeland Security's Cybersecurity Infrastructure Security Agency, or CISA, its webpage provides key resources, cybersecurity tools, incident response services, and assessment capabilities for critical infrastructure organizations. And the Department of Commerce's National Institute of Standards and Technology, or NIST, promotes trust in information technology, covering a wide range of areas, standards, and best practices. The NCUA's ASET cybersecurity assessment tool is based on the NIST cybersecurity framework. Finally, sir, we encourage credit unions to participate in and share with information sharing groups and organizations and law enforcement. Organizations such as the NCUISAL, the National Credit Union Information Sharing Analysis Organization, the Multi-State ISAC, or MSISAC, the FSISAC, the Financial Services Information Sharing Analysis Center, the FBI's InfraGuard, the U.S. Secret Service's ECTF, or Electronic Crimes Task Force, and the National Cyber Forensics Training Alliance in Pittsburgh, NCFTA. Each of these provide a panoply of cybersecurity-related resources and reporting that can assist credit union organizations to maintain their cyber resilience. That concludes my response to this question, sir.
Ernie, I really appreciate that comprehensive answer. And I'd now like to dive down just a little bit deeper into the new ASET assessment tool. Ernie, does it cost credit unions anything? How is it scalable? Will it educate credit unions about what they need to do to improve cybersecurity. Could you just give us a bit more information there?
Sir, yes, sir. This is Ernie Chambers. Thank you for that question. The ASET tool is offered at no cost to credit unions and is a downloadable assessment that provides credit unions with a repeatable, measurable, and transparent process for assessing their level of cyber preparedness. The automated cybersecurity evaluation tool provides a framework for analyzing cybersecurity vulnerabilities associated with an organization's overall information technology architecture, a consistent and technically sound methodology to identify, analyze, and communicate the security professionals' various vulnerabilities and consequences that may be exploited by cyber means, and serves as a means for the user to document a process for identifying cyber vulnerabilities, and it provides suggested methods to evaluate options for improvement based upon existing standards and recommended best practices. That concludes my response, Chairman Harbler.
Ernie, thank you very much. Finally, I know that we've spent a lot of time on this at the agency developing the new Intrex CU tool. Would you give us an update about it? When is it going to be available for examinations, and what are its capabilities overall?
Yes, sir. This is Ernie Chambers. Thank you for that question. We piloted Intrex CU for 18 months and obtained regional feedback for improvements. Based on the pilot results, we identified areas for improvement with Intrex CU and are working with the regions to rebuild the program to be scalable according to the institution's complexity and asset size. We plan to provide training and testing of the program through June of 2022 and then to finalize for rollout in September of 2022. Sir, that concludes my response.
Thank you, Ernie. In closing, all credit unions, regardless of size, are vulnerable to potential cyber attacks. The NCUA is committed to strengthening the readiness of the credit union system to respond to these risks through our supervisory program, tools like ASET, training, and the CDRLF grant and loan programs. I look forward to continuing to work with Vice Chairman Haltman and Board Member Hood on this important issue. Thank you again, Ernie. I now recognize Vice Chairman Haltman for his comments.
Thank you, Chairman, and thank you, Ernie, for that presentation. Cyber attacks are a fact of life for individuals, businesses, hospitals, schools, and governments. Not only are they pervasive, but the bad actors are continually shifting the goalposts, making it difficult to stay ahead of them. As I stated at last month's board meeting, none of us want to be the weak link when it comes to cybersecurity. NCUA's exam team has been stressing cybersecurity for several years now. I want to congratulate staff on the development of the Automated Cybersecurity Evaluation Toolbox, ASET. It's comprehensive and robust, and I especially appreciate that it was built to evolve. While I understand that the responsibility for cybersecurity rests with each individual credit union, I want to suggest that credit unions who make the effort to assess their level of readiness using ASET or some comparable tool get some sort of credit for it. I realize the examiner can't exempt the credit union if there's a problem, but using ASET or some other tool can help the credit union find and close those gaps sooner. Finding problems and fixing them is our goal. Thank you, Mr. Chairman. That concludes my remarks. I do have a couple questions. One is, ASET's a comprehensive tool for credit unions. Will our field staff be using it as well? And if so, how?
This is Ernie Chambers. Thank you for your question, Vice Chairman Hoffman. We are considering using the ASET in the future to measure the cybersecurity maturity of our institutions in evaluating the improvements made over time. As explained earlier, the ASET tool is not compulsory in any way. What is foremost is that credit unions arm themselves with the ability to detect, protect, and respond to cyber threats. Completing a cybersecurity assessment, any cybersecurity assessment, will provide institutions with a snapshot of their cybersecurity strengths and weaknesses, which in turn provides valuable insights to inform their risk mitigation strategies and action plans moving forward. That concludes my response, sir.
Thank you, Ernie. If I ran a credit union, I would definitely use ASET. But I realize credit unions aren't required to use the tool, but can you assure us they won't face repercussions if they do not?
Sir, this is Ernie Chambers. Thank you for that question. The ASET tool is designed to be totally self-administered by the institution. So no NCUA exam staff will engage with the institution during this self-administered assessment process. Relative to NCUA examination staff engaging in a happy or forthright, honest, and fulsome examination process, all NCUA examiners are expected to comport themselves professionally and not to antagonize or exhibit undue harshness during the execution of their duties. NCUA highly encourages the use and the implementation of the ASET tool for determining a credit union's cyber preparedness level, but there are many assessment tools that a credit union might employ to accomplish a risk-based assessment. The Department of Homeland Security's Cybersecurity Evaluation Tool, the CSET, the FFIEC's Cybersecurity Assessment Tool, the CAT, and the NIST Cybersecurity Framework are each suitable options, accessible at no cost to an institution in assisting them to shore up their cybersecurity preparedness. Understanding one's cybersecurity maturity, knowing where there may be gaps, and addressing those issues amounts to a safety and soundness imperative. Taking proactive steps, such as with the ASET Cybersecurity Maturity Assessment, can help to mitigate the risk of a cybersecurity data breach. Sir, that concludes my response.
Thank you, sir. If some credit unions have, a single-digit number of employees, if they haven't gotten around to it, but they do like the tool, can the examiner help them walk through it, spend a little time of the examiner's time, and do it themselves, or help the credit union do it?
Absolutely, sir. This is Ernie Chambers,
Yep.
And our examiners do exist to provide that level of support to our institutions. That concludes my response.
Gotcha. Yeah, I just, how the relationship between regulated and regulator is sometimes. If your regulator said, hey, have you used the tool we gave you? And the answer is no, and that requires more time from the examiner. All else equal, I'd want to give the answer that didn't make my examiner have to do more work. But if they did have to help, will this be done happily without any pushback or damage to the relationship?
Indeed, sir. We, again, this is Ernie Chambers, we hold our examiners to the very high standard of making sure that there's a complementary execution of the exam or assistance to make sure that they can move the enterprise forward without undue operational burden. That concludes my response, sir.
Thank you, Ernie, and I'm all finished. Back to the chairman.
Thank you very much. Board Member Hood, you are recognized.
Thank you, Mr. Chairman. And Ernie, I'd like to thank you for a very impactful and robust presentation this morning. And also, you did a wonderful job with this being your first time presenting to our board. So thank you for a job well done. National Security Awareness Month is underway this October, and I'd like to thank Chairman Harper for scheduling today's very timely briefing. The NCUA and credit unions are all working hard and diligently to keep up with the shifting demands that technology has wrought upon the financial services industry. Cybersecurity is indeed a top priority for both credit unions and for us here at the NCUA. I know for me, it's something that really keeps me up at night, and not just here as a regulator in the U.S., but when I talk to regulators from all over the globe, it is that one issue that we all talk about consistently. So with that in mind, we must keep working to protect members' data and to harden our systems against the various cyber threats and bad actors. I also, though, believe the collective spirit of the credit union industry must do more to help the smallest of credit unions address the cybersecurity issues. So I hope that our asset tool is something that they will be able to avail themselves of and to use it. But as we also all know, technology is simply more than a security threat. It's also an opportunity in the form of financial technology and access. I look forward to continuing to work with my fellow NCUA board colleagues regarding financial technology and access in the years ahead. Ernie, I just have one question for you at this time, and that is, given the remote work posture because of the COVID-19 pandemic, are there any specific cyber hygiene best practices that you might recommend for our smaller credit unions to implement?
Sir, this is Ernie Chambers. Thank you for that question, Board Member Hood. Good cyber hygiene is a general practice that can help an institution maintain safe and secure operations. That said, there are several best practices we would recommend to ensure an institution's cyber hygiene is the best that it can be. 1, installing reputable antivirus and malware software. Antivirus software is an umbrella of programs that scans for and eradicates computer viruses and other malicious software or malware. It's a vital component of one's overall cyber hygiene program. 2, using network firewalls. Firewalls are the first line of defense in network security and help prevent unauthorized users from accessing websites, mail servers, and other sources of information that can be accessed from the web. 3, updating software regularly and installing patches. Updating apps, web browsers, and operating systems regularly and automatically ensures they're working with the latest programs that have eliminated or patched possible glitches. These updates, sir, are particularly important because they often include software patches to fix flaws that could let in viruses or hackers. 4, setting strong passwords. Setting strong passwords for all devices on the network. Unique and complex passwords, at least 12 characters in length, will help prevent hackers from figuring them out. And then using multi-factor authentication. Multi-factor authentication is a best practice that offers an additional layer of protection. I could go on. There's backup and storage and many other measures to ensure good cyber hygiene and a good cyber hygiene regimen. But suffice it to say, sir, the aforementioned constitute a good base layer. Sir, that concludes my response.
Ernie, thank you for that very detailed response. And I would just like to note as a sidebar, you all with the ASET and all the things you've just articulated, Ernie, are designed for us here at the agency and also for our regulated entities, the credit unions. But after I had my briefing with you, I am putting into some of these cyber hygiene practices into my own personal and home life regarding multi-factor authentication and some of the other things. So I would just let everyone know some of these things that you shared, we can also incorporate into our personal lives as well for safety and soundness at home. So thank you again. I have no further questions.
Board Member Hood, that was a great question, and it's also a good observation that we need to practice good cybersecurity not only at work, but also in our homes. That concludes our cybersecurity briefing. The second item on our agenda today is Final Rule, Part 712, Credit Union Service Organizations. Staff presenting, Rachel Ackman, Senior Staff Attorney, Office of General Counsel. And staff available for questions include Myra Tepe, Director, Office of Examination and Insurance, Vicki Narwhal, Associate Director, Office of Examination Insurance, Frank Cressman, General Counsel, Ian Morena, Associate General Counsel, Office of the General Counsel, and finally, Simon Herman, Senior Credit Specialist, Office of Examination and Insurance. Rachel, you may begin at any time.
Thank you. Good morning, Chairman Harper, Vice Chairman Hotman, and Board Member Hood. On September 23rd, the board instructed NCUA staff to prepare a final rule on credit union service organizations, or CUSIS, by October 21st. I'm here today to present the requested final rule. At its January 14th meeting, the board issued a proposed rule to amend the NCUA CUSO regulations. Under the proposed rule, CUSOs would be permitted to originate any type of loan that a federal credit union may originate, and granted the board additional flexibility to approve permissible activities and services. The board received over 1,000 comments on the proposed rule. In general, consumer organizations and banking trade organizations were opposed to the rule. Credit unions were not unanimous, with some credit unions supporting it and others opposing it. CUSOs, credit unions, and trade organizations were generally in favor of the rule. The board is now finalizing the rule without any substantive change. I will now briefly summarize some of the material comments and the board's responses as included in the final rule. Some commenters who supported the proposed rule generally stated that the rule would not cause safety and soundness concerns and that the CUSO regulatory framework sufficiently protects federal credit unions and the National Credit Union Sharing Insurance Fund, or NCUSIF. In contrast, some of the commenters who opposed the proposed rule believe that it would have substantial unintended consequences and could affect the safety and soundness of federal credit unions and the NCU SIS. Commenters primarily focused on the NCUA's lack of examination or oversight authority and the systemic risk that arises from a few CISOs providing services to a large portion of credit unions. No changes were made to the rule in response to these comments, as the board does not believe the rule presents undue safety and soundness risks. First, CISOs are subject to a regulatory framework, for example, through state oversight and federal credit union investment and lending limits. The final rule also notes the board's belief that most CISO loans will be sold to insured credit unions, which are subject to NCUA enforcement and examination authorities. In the final rule, the board also states its position that the expansion of CISO authority does not undermine its request for examination and enforcement authority, as the rule provides only a modest expansion of federal credit union authority and results in only an incremental amount of additional risk to the NCU SIS. The board also includes that the rule may mitigate long-term risks to the credit union system, as the rule may be beneficial to federal credit unions by enhancing their competitiveness and ability to generate capital. Commenters who are against the proposed rule generally expressed concerns that the proposed rule would create consumer protection concerns to members. Several commenters expressed concerns that CISO-originated loans are not subject to the same restrictions as loans originated by federal credit unions. For instance, the Federal Credit Union Act limits interest rate, maturity, and prepayment terms for federal credit union-originated loans. In the final rule, the board stated its belief that more collaboration and use of financial services technology may positively affect financial inclusion. By authorizing more parties to offer an array of consumer loans, the board may increase beneficial competition and expand consumer choice. In addition, the final rule states that CISOs may adhere to the statutory and regulatory restrictions on loans that federal credit unions are empowered to grant in order to be able to sell those loans to federal credit unions. The board also stated in the final rule that there are state usury laws and other consumer protection laws that may curtail the risk of predatory lending by CISOs. Several commenters also discussed the fact that CISOs enable necessary innovation. Commenters discussed that CISOs are currently helping credit unions survive in the rapidly changing financial industry, and several credit unions credited CISOs with assisting them in reaching members, including low to moderate income members. Other commenters pointed out that because CISOs are already able to facilitate federal credit unions' collective investment in technology, including lending technology, they do not need their lending powers broadened for technology-related reasons. In response, the final rule states that it's the board's belief that affording greater opportunities for federal credit unions to lend to and invest in CISOs engaged in a broader range of lending may facilitate more partnerships that position federal credit unions better to work with new entities and technologies in financial services. Several commenters who supported the proposed rule also stated that the proposal is necessary for federal credit unions to remain competitive as lending becomes more standardized and consumers move online for more of their financial services. Many commenters discussed a recent trend of point-of-sale financing. According to these commenters, consumers are acquiring credit at the point of sale instead of through a credit union first. Commenters were particularly concerned about this trend for auto loans. Some commenters believe that credit unions risk diminishing market share if CISOs are not permitted to contract with national lenders. The board agrees that expanding CISO lending authority to cover auto loans may help credit unions compete at the point of sale. Existing data also supports the board's belief that small credit unions are struggling to compete in auto lending, and that the final rule may support small credit union auto lending efforts. Therefore, after consideration of comments, the board decided to finalize the expanded lending authority substantively as proposed. The proposed rule also included additional flexibility for the board to approve permissible activities and services without engaging in notice and comment rulemaking. The list of permissible CISO activities currently includes many of the core services and activities associated with the daily and routine operation of credit unions, but does not provide the board flexibility to consider additional activities and services without engaging in notice and comment rulemaking. The final rule adopts the proposed amendment to provide the board such flexibility and states that this change may also help keep CISOs keep pace with innovation. The NCUA also sought comment on broadening general federal credit union investment authority in CISOs based on the Federal Credit Unions Act provision that authorizes federal credit unions to invest in organizations providing services associated with the routine operations of credit unions, which is codified in separate provision from the authority for federal credit unions to lend to credit union organizations. No changes were made to the final rule, but the final rule states that the board will consider these comments in determining whether to propose any changes to its existing interpretation the regulatory definition of a CUSO in the future. I can now answer any questions you have about the final rule.
Thank you, Rachel. Board Member Hood, I know that this rulemaking has been a priority for you, so you are recognized first to speak.
Great. Thank you, Mr. Chairman, and thank you, Rachel, for a very insightful presentation this morning. So as not to leave anyone in suspense, let me be clear that I certainly believe that credit union service organizations are what will help credit unions, and in particular, mid-sized and smaller credit unions, stay relevant in the years ahead by continuing to grow and scale in the cooperative spirit while ensuring the industry is responding to the rapidly changing landscape. I certainly am hoping and encouraging my fellow colleagues to support this proposal. 10 years ago, you rarely heard of anyone buying a car online. Today, buying a car online is more common. For me, it's hard to fathom and believe you have more and more consumers never stepping foot into the automobile dealership. Indirect auto lending is critical for credit unions. So we need to give credit unions the tools to scale and compete in the online marketplace. We simply cannot sit back and watch the automobile market evolve without doing anything about it. It should, in fact, be noted that most credit unions supported today's rule in their comment letters. There was small opposition in the comment letters we received when you take out all of the identical form letters, and I'd like to address now some of the individual concerns raised. Specifically, some have said that this rule will allow credit unions to become payday lenders. Pernicious payday lenders run counter to the people helping people philosophy, and I believe these concerns are simply unfounded. We all know around the industry, when I speak, I talk about the role that these pernicious payday lenders have done in preying upon vulnerable and marginalized communities. And under no circumstance would I ever approve or adopt any type of rulemaking that would put our vulnerable members in the hands of pernicious payday lenders. Greater competition in the consumer loan market from federal credit union-owned entities is likely to introduce better consumer options and provide greater choice. If the board decided to limit innovation and expansion out of concern for potential consumer harm, it may in fact perpetuate a lack of consumer choice and access. Regardless of what action the board takes today, other parties will continue to lend in the marketplace and sadly may lack the same grounding in the credit union mission and industry that would tend to mitigate the risk of abusive lending practices. Confronted with this choice, it is clear that CUSOs will be more likely than other lenders to offer only reasonable terms to consumers and be held accountable by the NCUA and other federal agencies such as the CFPB and or state authorities. Some have raised concerns that this rule would create a Wild West within the credit union space with little accountability for consumers. CUSOs can already engage in lending for mortgages, student loans, business loans, and credit cards. Again, these types of lending efforts are already carried out by CUSOs without unnecessarily impacting safety and soundness of our industry and the National Credit Union Share Insurance Fund. And it hasn't created a so-called Wild West within the credit union system. But let's explore this further. First, does the NCUA charter CUSOs, or are they chartered as in states that are domiciled under the existing law? So could someone please answer that, Rachel? I know you may have some others that are with you today.
I can answer that one. This is Rachel Axton. You're correct. NCUA does not charter CUSOs. They're chartered under state law. That concludes my answer.
Okay, thank you. So therefore, can we infer that the NCUA charters credit unions but not CUSOs, correct?
This is Rachel. That is correct.
And continuing, thank you. And Rachel, continuing, when a CUSO is chartered in the state, it must abide by the laws of that state. Is that correct?
This is Rachel. Yes, that is correct. They must abide by the laws of that state, and they would be subject to the state consumer protection laws. That concludes my answer.
Very well. So then in that vein, that would include state usury laws and state consumer protection laws?
This is Rachel. Yes, it would include state usury laws and consumer protection laws to the same extent as other entities chartered in that state. That concludes my answer.
Great. So then continuing, Rachel, a CUSO does not get a pass from usury laws or consumer protection laws then, simply put.
this is Rachel. They wouldn't unless there's some states, my understanding, have exceptions to certain of their usury laws. So they would be held to the same extent as other entities in that state. There would be no exception for them being related to credit unions. And that concludes my answer.
Very well, then, and thank you for those responses. So saying this would create a Wild West is an assault on all of our fellow state regulators with whom we work in partnership. And I believe this industry is best served by a strong dual system of regulation with mutual respect between federal and state regulators. Mr. Chairman, I'd like to point out that the extent of permissible CUSO lending has been considered and reconsidered by the NCUA board, from what I understand, for many years now. The board has been considering today's specific action since 2018, so well before we both came here in April of 2019. I'll repeat, since 2018. In specific, the concept for this rule was issued in a December 2018 Regulatory Reform Task Force report that said this rule would require a low effort in terms of staff's time to produce this rule and have a high impact. In today's marketplace, credit unions need to increasingly rely on pooling their resources to fund CUSOs, to build the infrastructure consumers are demanding, and to compete with the captive auto lenders. Today's rule is a natural evolution and allows CUSOs to compete in a marketplace that is very important for credit unions. I certainly believe that now is the right time to reconsider the types of lending that are permissible for CUSOs and whether additional opportunities for collaboration will help credit unions, especially our smaller credit unions, our MDIs, our low-income designated, and our CDFI credit unions. In total, it's going to help them all remain competitive in a rapidly changing and dynamic financial landscape. Today's CUSO rule also enhances competition in the automobile marketplace without undermining credit unions who already are competing in this space. Regardless, I am a believer in the marketplace, and in my view, more competition is always better for consumers. Some may say that it's not appropriate to do this rule at this time until the NCUA has vendor authority. But I disagree with that assessment because waiting for vendor authority will then prevent credit unions from having all the tools they need to serve their member owners today. Additionally, vendor authority is a decision for Congress. And although I have publicly gone on the record requesting vendor authority for credit unions once the pandemic subsides, granting the NCUA vendor authority, again, is not a decision for the NCUA board. It's a decision for Congress. And regarding vendor authority, I would like to note for the record, NCUA did in fact have vendor authority leading up to Y2K and its sunset. So in most of my messaging, I've mentioned when I meet with members of Congress, it's not a matter of giving NCUA vendor authority, it is a matter of reinstating vendor authority. And in closing, and perhaps most importantly, today's rule requested comments on investments. The reality is the Federal Credit Union Act gives CUSOs the authority to invest and the authority to lend. These are two separate authorities using two separate terms in the statute. The law says that CUSO lending primarily must serve credit unions. The law doesn't prescribe this requirement for CUSO investments. In the late 1970s, the agency determined CUSOs should be viewed as one entity, not as two separate entities as allowed by law. I believe in 2021, this approach is far too restrictive and should be reconsidered. In today's rule, we asked if we could separate our view of CUSOs into CUSO investing and CUSO lending. Credit unions and not just banks should be able to invest in fintechs offering routine and daily operations for financial institutions with the proper safety and soundness guardrails without regard to serving credit union requirement. Let me be clear. Today's rule is significant, but the rule does not go, in my opinion, far enough. I would like to see CUSOs be allowed to invest in fintechs directly with the proper safety and soundness guardrails. In 2021, this requirement is again overly prescriptive. In fact, many commenters supported us reconsidering our view. Several commenters stated that the federal credit unions can get left out of the development of fintech because of the requirement to primarily serve member owners. Several commenters also stated that additional investment authority would ensure the industry has better leverage, control, and influence in the development of new technology. We don't need to watch credit unions get left behind because of fintechs. And that is happening right now since QSOs cannot invest in fintechs unless those fintechs become a QSO, something that isn't workable for a lot of fintech companies. And I know because I meet with at least 5 fintech companies a week to learn about their enterprises. QSOs and the credit unions and their members who own them can and should be on the forefront of fintech investments. I believe these investments are critical to keep the credit union system safe and sound in the long term, as credit unions should be at the table working directly with fintechs. Without investments in fintechs, the credit union system runs the risk of becoming stagnant in the years ahead, as the cooperative system must respond to the changing dynamic environment we find ourselves in today. And so too should the industry's regulator. I will repeat that we should move forward in granting this investment authority with the appropriate safety and soundness guardrails. I view today's rule as a significant milestone for credit unions, but our work here is not done with regard to QSO investments. And I will be calling in the years ahead or in the months ahead on my colleagues to address this matter during my remaining tenure on the board. I do now have a few remaining questions. Rachel, how many losses have been directly attributed to QSOs to the Share Insurance Fund? In specific, what were these losses?
This is Rachel. I'm going to ask D&I if they can answer this question for you. This includes my answer.
Hi, Board Member Hood. This is Vicki Narwhal. I'll take that question. Sorry, I couldn't get my phone off mute fast enough. So E&I does not track losses specifically associated with QSOs, so it's difficult to arrive at an overall amount of losses. We track costs associated with credit union failures. We don't necessarily break out and track them to specifically identify QSO losses. Additionally, if a credit union loses money due to a QSO but doesn't fail, we're not formally tracking those losses. Having said that, we do know that 73 credit unions incurred losses due to QSOs between 2007 and 2020. And of those 73 credit unions, 11 failed, causing $305 million in losses to the Share Insurance Fund at the time of failure. QSOs contributed, but did not exclusively cause the entire $305 million in losses. And that concludes my response.
Great. So thank you for that response. So it's probably difficult to assess correlation or causation in that case. So thank you for your remarks. What is the intention of collecting additional information from QSOs engaged in activities such as lending for NCUA's QSO registry? I don't know who wants to take that question.
This is Vicki Narwhal. I'll take that one too. So as stated in the 2013 final rule, the intention of collecting this additional information is to identify emergent risks posed by QSOs and to protect the Share Insurance Fund. And that concludes my response.
Great. Thank you, Vic. And I just have one final question. Can you please explain how the NCUA believes the incremental risk to the Share Insurance Fund posed by the expansion of QSO authority is mitigated? What are those mitigating factors?
Sure. This is Vicki Narwhal. I'll take that as well. So federal credit unions only have the authority to lend up to 1% of their paid-in and unimpaired capital and surplus, and to invest an equivalent amount in total in QSOs. So these investment and lending limits mitigate risk to the Share Insurance Fund. Additionally, Section 712.3D requires that all federally insured credit unions that obtain an ownership interest in a QSO ensure by contract that the NCUA has access to the QSO's books and records and other information and reports. QSOs are also subject to state lending laws and federal consumer protection laws. These and other regulatory requirements discussed mitigate the potential risk to the Share Insurance Fund. And that concludes my response.
Thank you, Vicki. I do have a slight follow-up. Isn't there a maximum that the QSOs and the credit unions can invest? And I thought it was something notional along the lines of 2% from what I read.
So the aggregate amount in which CUSOs can invest and loan, so it's 1% invest and 1% loan. So the aggregate would be a total of 2% of their unimpaired and the paid in and unimpaired capital and surplus.
Great, thank you. That's really worth noting, you all, because I just want folks to know that 2% notional, in my opinion, would hardly have a deleterious impact on our share insurance fund. So thank you, Vicki and Rachel, for your presentation this morning. I have no further questions, Mr. Chairman. I yield back my time to you.
Thank you very much, Board Member Hood. Vice Chairman Huffman, you seconded the motion to bring this matter to the board at this meeting. You are recognized next to present.
Thank you, sir. And thank you, Rachel, for your presentation. As Mr. Hood just mentioned, the expansion of permissible CUSO lending has been under consideration for many years now, most recently in NCUA's Regulatory Reform Task Force in 2018. Under the Federal Credit Union Act, federal credit unions may invest and make loans to CUSOs. The modern CUSO rule was passed by NCUA in the early 80s. In 2008, the list of pre-approved activities and services in the CUSO rule added 2 new categories of permissible CUSO activities: credit card loan origination and payroll processing services. This is a long way of saying that CUSOs have been making direct consumer mortgage loans, business loans, and student loans for decades without negatively impacting credit unions. Without CUSOs, many credit unions, especially the small ones, would not have had the scale to compete in the mortgage, business, credit card, and student lending areas. Credit unions, through their CUSOs, have been able to provide members with more choice in the marketplace. In 2008, NCUA declined to allow CUSOs the authority to make direct consumer loans. A lot has happened since 2008, and that is why we are here today. We've all probably noticed the change in TV advertisements for automobiles. There's fewer ads for places like Bethesda Chevrolet and more for new online services like Carvana. And if you Google something like, what's the price of a 2018 Honda Civic, the top search results are for online car buying services. Consumers are now using their mobile phones to comparison shop for the best car and financing without ever having to go into a dealership. The pandemic has only accelerated this evolution, and there's never been more price transparency. This is all similar to what sites like Travelocity did to prices for hotels and airlines. The technology and scale necessary to compete in an online consumer and auto marketplace is beyond the reach of most individual credit unions. The U.S. Treasury Department has noted that non-bank digital lenders have gained outsized attention, driven in part by their rapid rate of growth and employment of new technology-intensive approach to lending. From the consumer angle, this rule just adds one new way to buy a car. All the other methods remain in place. And obviously, the best consumer protection has always been a competitive market. In a world where consumers use their mobile phone to comparison shop for pricing, why would they take a worse deal if they know they can get a better deal someplace else? People will still have all the other financing options that are available today. For example, credit union members will still be able to get pre-approved by their credit union and have a check in hand while speaking to a dealer. And I can't not mention the folks who've expressed concern that adding one more auto financing option will somehow result in consumers being ripped off. Those critics all seem to have one thing in common. None of them think that they personally would suddenly wind up paying more for a car. They just think that there's these other people who will pay more than necessary. And paternalism has always made for bad policy. CUSOs follow state and federal consumer protection laws already. The digital era also makes the threat of scalding online reviews a significant risk to businesses that don't treat consumers well. I'll also mention that NCUA continually reviews existing rules, which is why we're going to monitor how this rule actually works in a real world, including watching consumer issues and if CUSOs are promptly delivering these loans to credit unions. These rules we make are sometimes more art than science. Other than Michelangelo's David, there are a few perfect works of art. So if this rule needs to be tweaked in the future, then we'll tweak it. Thank you, Mr. Chairman. That concludes my remarks. I do have a question, and it's for Rachel. At the January meeting, Rachel, we talked about this, and you stated, we don't expect the proposed rule to be disruptive to credit unions. CUSOs have been originating loans that are also core credit union lending products for over 30 years, and they haven't impacted credit unions negatively so far, end quote. Rachel, is that still the case?
This is Rachel. I believe that is still the case, as far as I'm aware. Most of the comments we received were about the new authorities and not the existing authorities. Thank you, and that concludes my answer.
Thank you, Rachel. That concludes all my questions. Back to the chairman.
Thank you, Vice Chairman Haltman and Board Member Hood, for sharing your views and expressing your support for this final rule regarding credit union service organizations, or CUSOs. Specifically, this rule will allow CUSOs to engage in any type of lending permissible for federal credit unions. It will also provide additional flexibilities for the NCUA board to approve permissible activities and services outside of the standard notice and comment process. It should come as no surprise to anyone who has followed this rulemaking that I strongly oppose the final CUSO rule before us today. And while I will soon outline in greater detail my many concerns regarding this rulemaking, I will begin by discussing what I like about this rulemaking. First, I am grateful that my colleagues agreed with me to extend the initial 30-day comment period to 60 days. The matter before us is controversial, and the rulemaking generated considerable comments. In all, we received more than 1,000 letters, one of the largest sets of public comments the agency has ever received. The additional comments we received during the extension allowed the agency to consider a great variety of perspectives on these matters. Second, I am appreciative that the preamble for this final rule reaffirms the board's continuing policy to seek third-party vendor authority from Congress. While I may disagree with moving this rule before the agency has obtained such statutory powers, or as Board Member Hood properly noted, have them reinstated, I believe it is important for the board to express its continued support for this much-needed legislative reform. That said, there is a classic philosophical difference on this rule. On the one hand, my colleagues believe that the changes contained in the final rule will help small credit unions to compete and remain viable. On the other hand, I believe that unleashing such competition within the credit union system will lower earnings for smaller credit unions because of the earnings CUSOs will siphon off the top from participating credit unions. This will then lower returns on loans and lower credit union returns on average assets. As a result, this rule in the long run will likely lead to further industry consolidation. Given the differences in our policy perspectives, we were unable to reach consensus today. I am, nevertheless, hopeful that we will reach an agreement on matters like the field of membership shared facility requirements and the mortgage servicing rights that the board will consider in the coming months. Let me start my examination of this rule by focusing on consumer financial protection. CUSOs making loans under this proposal would not be subject to the same loan restrictions as federal credit unions. As a result, they could exceed the limits on maturity, interest rates, and prepayments that federal credit unions must follow. As such, consumer advocates have called on the NCUA board to, quote, abandon this proposal, unquote. Their concerns are well-founded. The final rule would give CUSOs the ability to become indirect auto lenders and payday lenders. Consumer advocates agree that these two consumer financial products carry considerable compliance and reputation risk. 1 decade ago, some CUSOs did engage in predatory payday lending. One such CUSO, known as NICS, had products charging an effective 262% annual percentage rate. Another CUSO product, CU on payday, had a true annual percentage rates ranging from 141 to 876%. It took the NCUA and the actions of others several years to close down these problematic loan products. With today's action, however, we will reopen the door to similar predatory scams. Additionally, during the last decade, the NCUA board has sought to create an environment in which individuals could obtain safe, affordable, and fair access to short-term credit with its payday alternative loans rule. Yet this final rule will allow CUSOs to engage in payday lending that exceeds rate caps and without consumer protection guardrails. That action will set back the agency's long-term efforts to create access to credit for provident and productive purposes and runs counter to the spirit of the Federal Credit Union Act. As stewards of the credit union system, the NCUA board should act to safeguard consumers and protect the system from sizable losses to the Share Insurance Fund. Because the agency lacks the third-party vendor authorities that other federal banking agencies and several state regulators have, the NCUA has no power to supervise CUSOs for compliance with federal consumer financial protection laws and regulations and compliance with prudential standards like concentration limits, maximum loan-to-value ratios, and minimum capital levels. A lack of supervision is a reason for more guardrails, not fewer. Yet, in adopting the final rule today, we will not be taking substantive action to close these regulatory blind spots. Instead, the final rule will create an unregulated Wild West within the credit union space with little accountability for protecting consumers and credit unions. The Federal Credit Union Act's purpose is to promote thrift among credit union members and create a source of credit for provident and productive purposes. In allowing CUSOs to make loans that exceed rate caps and maturity limits, we are evading these statutory obligations. Previously, the courts have affirmed the NCUA's decision to dissolve a federal credit union on the grounds that it failed to promote thrift as required by its charter. Here, however, we are now allowing CUSOs to make such loans within the credit union system without any authority to shut down problematic lending and activities down. I've spent more than 2 decades working on financial services issues, and one thing that I have consistently observed is that problems often develop in the areas receiving inadequate oversight and ineffective regulation. Think about the collapse of Enron, the savings and loan crisis, and the subprime lending debacle. With this rule, we would be inviting bad actors to come into a lightly regulated space. That is a recipe for disaster. To paraphrase one commenter on this rulemaking, why are we providing CUSOs with all of the powers of federal credit unions without applying commensurate prudential supervision or consumer safeguards to mitigate risk? That is a very good question, and it remains unanswered in this final rule. Likewise, another commenter observed that this rulemaking will likely migrate many existing credit union members from direct credit union services to an outside lender, free of NCUA supervision and examination, to provide the full range of their borrowing needs, stripped of the protections afforded under the Federal Credit Union Act and NCUA's regulations. Within appropriate levels of risk, we should be acting to protect the Share Insurance Fund from losses. Instead, this rulemaking will likely increase such losses in the years ahead. My fear of future losses to the Share Insurance Fund is not hypothetical. It is a fact. And when the losses occur, it will be the surviving credit unions and their members who will pay the bill for the misdeeds of others. That deeply troubles me. According to staff calculations, and as Vicki noted earlier, at least 73 credit unions incurred losses to CUSOs between 2007 and 2020. Ultimately, the failure of 11 of these credit unions caused $305 million in losses to the Share Insurance Fund. What is more, when combined with the CUSO-caused losses at credit unions that did not fail, the total losses to the system were nearly $600 million. In an attempt to downplay these losses, the final rule asserts 2 points. First, a CUSO must be sufficiently bonded or insured. While such bonds may be useful in covering small losses related to petty thefts, small-time fraud, and other inappropriate management actions, these bonds will not cover large losses. And second, the final rule maintains that a past pattern of material losses is not sufficient evidence that the pattern will continue. This viewpoint is troubling. History may never repeat itself, but it often rhymes. And when it does rhyme, it will be the surviving credit unions and their members who will pay for these losses. Moreover, we saw what happened when a CUSO focused on business lending ran amok during the Great Recession. The credit union with more than $1 billion in assets, which also had a wholly owned CUSO, was placed into conservatorship. And to protect the system from sizable losses, the NCUA had to provide a $60 million line of credit. Without such Section 208 assistance under the Federal Credit Union Act, the credit union would have been insolvent, and the credit union's failure would have created a sizable problem for the Share Insurance Fund at a time when the industry was already coping with the catastrophic losses created by the corporate credit union crisis. Problematic QSO activities continue to this day. In fact, earlier this year, the NCUA was forced to liquidate a small credit union because of its troubled mortgage lending QSO. With this rule, I fear that we are opening the door for similar situations in the future, but this time in payday and auto lending. Many have recognized the existing QSO regulatory blind spot within the credit union system. As such, the Government Accountability Office and the Financial Stability Oversight Council have repeatedly recommended that the agency have vendor authority to oversee QSOs and other third-party vendors. And the NCUA's own Inspector General has noted that we need such authority to effectively identify and reduce the risks vendor relationships pose to credit unions and to protect the Share Insurance Fund from losses. The first step is to provide QSOs with providing QSOs with expanding powers should have been the adoption by Congress of vendor authority. With such authority, we should have been able to address the risks that arise from vendor relationships and safeguard the Share Insurance Fund. Instead, this final rule will make the regulatory blind spot even worse. In fact, we know that QSOs have previously denied NCUA reviews and rejected recommendations to mitigate risks. With the adoption of this final rule, it is only a matter of time before we encounter similar responses from QSOs making and selling loans under these new authorities. To divert attention away from this blind spot, the preamble of this final rule notes that the agency could use its broad investigative subpoena authority to compel records and testimony if QSOs do not allow the NCUA to conduct reviews. This suggestion ignores the difference between a confidential supervisory program and a more adversarial legal proceeding. It is also a hope, not a fact. In reality, the agency has never exercised this authority. When the board adopted the QSO proposal, I expressed concerns that the net result of this rulemaking would be to strengthen QSOs and weaken the competitive position of many credit unions. Many commenters agreed with these observations. For example, Idaho Central Credit Union expressed its strong opposition to the rule in noting that not only does the rulemaking raise safety and soundness issues, but it could also damage the relationship credit unions have worked for years to build and develop with car dealers. When implemented, this final rule will make it more difficult for a credit union to maintain the viability of these relationships. It will also limit the ability of a credit union to control its risk tolerance and look out for the best interests of its members. I very much agree. Similarly, Unitas Community Credit Union wrote that the proposal's economic impacts have not been widely discussed and understood by a majority of credit unions, which may have an economic service models materially disrupted by the adoption of this final rule. Unitas also observed that there is often a significant discrepancy in transparency of pricing of services offered, which often impacts small to mid-sized credit unions, especially when the governance is controlled by large shareholders at the QSOs. Further, the credit union observed that the rule would result in the transfer of credit risk to smaller credit unions, while the ancillary income like guaranteed asset protection and credit life auto insurance are generated and retained by the QSO. While the low margin and credit risk is passed on to the credit union, the higher margin income is retained and benefits of the largest credit union equity partners of the QSO. In that regard, more often than not, credit union ownership of QSOs is concentrated in the largest credit unions. In fact, for credit unions with an ownership interest in 5 or more QSOs, the median asset size is in excess of $1 billion. It is also worth noting that the return on average assets for credit unions with less than $100 million in assets is just 39 basis points, regardless of whether they own or use or just use a QSO. In comparison, for credit unions with more than $100 million in assets, the return on average assets is 61 basis points for those institutions with no QSO ownership interest and 72 basis points for credit unions that own a QSO. Thus, there is a strong likelihood that larger credit unions owning CUSOs will benefit from this change, while smaller credit unions will not receive the same benefits. Given these competitive concerns, the agency should have conducted an in-depth economic analysis before proceeding to the consideration of a final CUSO rule. That said, the NCUA is required to complete 2 analyses under the Regulatory Flexibility Act and the Small Business Regulatory Enforcement Fairness Act. Even these required analyses and reviews have fallen short. The Regulatory Flexibility Act generally requires that, in connection with a final rulemaking, an agency prepare and make available for public comment a final regulatory flexibility analysis that describes the impact of a rule on small entities. For our purposes, we define small entities as credit unions with less than $100 million in assets. That is 2 out of every 3 credit unions. Given their small size, we know that smaller credit unions are more reliant on CUSOs to provide needed services to their members. So it makes sense that credit unions under $100 million would rely on CUSOs and face new competition for lending, especially in the area of auto loans under this final rule. Yet, I'm unaware of any actual economic analysis conducted on this point. That is a flaw of this rulemaking. Likewise, the Small Business Regulatory Enforcement and Fairness Act of 1996 requires a determination of whether a regulation is a major rule because it will cause an economic impact of $100 million or more annually. From my discussions with staff, I have learned that there may well be an annual impact exceeding that threshold. After all, we know that credit unions are heavily involved in auto lending, a market that exceeds $1.2 trillion in loans outstanding. In all, the market share of credit unions is just over 30%. Once implemented, it is entirely plausible that CUSOs could capture 1% of the auto market. Under some reasonable assumptions, that could produce an economic impact of $100 million or much more. The agency should have taken the time to calculate this estimate and not rush to finalize today's rule. Instead, we may well face criticism from the Office of Management and Budget, Congress, and the courts for short-circuiting these required analyses. Before closing, I briefly want to discuss 2 other concerns I have with this rulemaking. First, this rule is the wrong rule at the wrong time. In the current economic environment, the NCUA board should be working to adopt rules, protect consumers, and prepare the system for the likely coming credit losses as COVID-19 relief programs come to an end. This rule is not pandemic relief. And second, the final rule will give the board additional flexibility to approve permissible CUSO activities and services outside of the standard notice and comment process. In the process to allow new CUSO services to get added, the agency is avoiding formal rulemaking when it comes to expanded CUSO's powers, but it will require rulemaking when limiting CUSO powers. This regulatory approach is lopsided. The agency should have kept the existing process instead to require notice and comment in all instances. In closing, there is much to dislike about this rulemaking. It will give CUSOs the ability to become indirect auto lenders and payday lenders without applying consumer protection and prudential guardrails. It will also increase a regulatory blind spot and foster regulatory arbitrage. What is more, the final rule will negatively affect the competitiveness of small credit unions who will make lower earnings on the loans that they will have to buy from CUSOs instead of making those loans directly. Finally, the rule will ultimately lead to losses for the Share Insurance Fund. We should have taken the time to better estimate the magnitude of such losses and the competitive impacts of this rulemaking. For each of these reasons, I will oppose this final rule. That concludes my remarks. Is there a motion?
Yes, Mr. Chairman. I move that the board approve Final Rule Part 712 of NCUA's Rules and Regulations as detailed in the Board Action Memorandum.
Thank you. Is there a second to the motion?
I second the motion.
There is a sufficient second. All those in favor say aye.
Aye.
All those opposed say nay. Nay. The ayes have it. And let the record show the motion is passed 2-1. The third and final item on our agenda today is Final Rule Parts 700, 701, 703, 704, and 713, CAMELS Rating System. Staff presenting, Tom Fay, Director of Capital Markets, Office of Examination and Insurance, Rob Bruneau, Senior Capital Markets Specialist, Office of Examination and Insurance, and Marvin Shaw, Senior Staff Attorney, Office of General Counsel. Staff available for questions include Myra Tepe, Director, Office of Examination and Insurance, and Vicki Narwhal, Associate Director, Office of Examination and Insurance. Tom, you and your team may begin when you are ready.
Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. This is Tom Fay, Director of Division of Capital Markets from the Office of Examination and Insurance. Joining me in presenting this CAMELS final rule for your consideration is Marvin Shaw, Senior Staff Attorney from the Office of General Counsel, and Rob Bruneau, Senior Capital Market Specialist from the Division of Capital Markets in the Office of Examination and Insurance. We are here to present for your consideration a final rule that revises the CAMEL rating system. Consistent with the board-approved proposed rule from January 2021, this final rule amends the existing CAMEL rating system for both corporate and natural person credit unions by adding an S component to assess sensitivity to market risk and modifying the L component to include only the liquidity evaluation content and rating criteria, thus adopting the CAMELS rating system. Additionally, the update to CAMELS requires amending the term CAMEL to CAMELS in several sections in NCUA rules and regulations. Marvin will provide an overview of the comments that NCUA received from the January 2021 NPR, and Rob will provide some background and a general overview of the CAMELS final rule, including some of the clarifying changes we recommend to the proposed rule as part of this final rule. I will now hand it over to Marvin. Marvin, you can start. Thank you.
Sorry about that. Thanks, Tom. Good morning. This is Marvin Shaw, and I'll be providing a brief summary of the comments NCUA received on the January 2021 CAMELS NPR. In response to the proposal, the agency received 16 comments. Commenters included National Credit Union Associations, state credit union leagues, credit unions, and individuals. Most commenters supported the proposal, stating that it would improve supervision of risks and would enhance the consistency with other financial regulators at both the state and federal level. A few commenters expressed concern about increased costs, especially for smaller credit unions. In addition, a few commenters requested a greater lead time for implementing the change to CAMELS. This concludes my remarks. I will now hand the presentation over to Rob to give an overview of the modest changes made in the final rule.
Thank you, Marvin. This is Rob Bruneau. Good morning, Chairman Hartman, Vice Chairman Hopman, and Board Member Hood. The NCUA's current CAMEL rating process addresses both sensitivity to market risk and liquidity risk within the L component. While there is an interrelationship between sensitivity to market risk and liquidity risk, there are also differences that support separating the risks into distinct CAMELS components. As Tom mentioned in his opening remarks, this final rule will enhance the existing CAMEL rating system by adding an S component to separately assess sensitivity to market risk and modify the L component to include only liquidity evaluation content and rating criteria. The addition of the S component will enhance transparency and allow the NCUA and federally insured credit unions to better distinguish between liquidity risk and the sensitivity to market risk. This final rule will also create greater consistency with the other banking agencies and approximately 24 state supervisory authorities who already use an S component for sensitivity to market risk. It will improve the examination communication of sensitivity to market risk and liquidity risk between examiners and credit unions, and because of more refined interest rate and liquidity risk rating assessments, NCUA's monitoring and analysis of interest rate and liquidity risks will improve at both the individual credit union level and across the credit union system. This in turn may improve the allocation of specific resources. The adoption of the CAMELS rating system involves two changes: adding the sixth component, sensitivity to market risk, or S, and updating the existing liquidity component, or L, to only include liquidity evaluation contents and rating criteria. The CAMELS rating system does not include any other changes to the existing capital adequacy, asset quality, management, or earnings components, nor the evaluation guidance and rating criteria to assign the composite rating. As part of this final rule, CAMELS would be effective for all exams starting after April 1st, 2022. To implement this final rule, we are planning an outreach and training program during the first quarter of 2022 that would include the following: training on independently evaluating the S and L components and applying the CAMELS rating system for any NCUA and state supervisory authority staff that require the training. A letter to credit unions detailing the rating descriptions and criteria for CAMELS. Finally, an industry webinar to ensure credit unions have an opportunity to become familiar with the new S component and the updated L component of the CAMELS rating system. Outside of becoming familiar with the new S component and updated L component, little more should be required from credit unions to prepare for the transition to CAMELS. The update to CAMELS is an enhancement to NCUA's current supervision program. Credit unions of all sizes do not need to do anything more than they are already doing, including credit unions greater than $50 million in total assets that must comply with the policy requirements of the interest rate risk rule. Consequently, staff believes that the April 1st, 2022 transition to CAMELS can be done smoothly without burden or significant disruption to credit unions, the examination process, or agency operations. As Marvin mentioned, non-substantive but clarifying changes were made to the proposed rule to form this final rule. These changes primarily involve the rating descriptions for the S and L components to enhance the differentiation between the 1, 2, 3, 4, and 5 ratings. These clarifying changes help better communicate to credit unions and examiners the distinguishing criteria of some S and L ratings. Notwithstanding these non-substantive modifications, the S and L rating criteria remain highly consistent with the other banking agencies' S and L component ratings. For any state supervisory authorities that choose not to adopt CAMELS, NCUA will follow its current CAMELS disclosure policy. The policy will require examiners to strive to disclose the NCUA CAMELS rating simultaneously with the state supervisory authority's CAMEL disclosure during the final meeting with management and officials. Thank you, and this concludes our prepared remarks. We'll be happy to answer any questions.
Thank you, Rob, Tom, and Marvin, for providing the NCUA board with an overview of the final rule to add a market sensitivity risk component to the CAMEL rating system. Each of you and your teams did a great job working together to finalize the rule the board will vote on today. Myra, thank you as well. And actually, let me also say that for Vicki for being available to answer questions today. And thank you, Board Member Hood, for getting this rulemaking rolling at the start of this year. In my view, the NCUA's adoption of the CAMELS system is good public policy and long overdue. Separating the liquidity and market sensitivity components will allow the NCUA to better monitor these risks within the credit union system, better communicate specific concerns to individual credit unions, and better allocate resources. In January, when the board issued the proposed rule, I also said that this rating system adjustment has been a very long time in coming. After all of the federal banking agencies added a market sensitivity risk component to their CAMEL systems in 1997. Additionally, 24 of our state partners have already adopted the CAMEL system to assess more accurately the risks of the credit unions that they regulate. Thus, in adopting these revisions today, we are enhancing the consistency in the supervision of credit unions and other depository institutions. And as I understand, many of our state partners that have not yet adopted CAMELs will follow our lead and modify their rating systems in conjunction with our change. The growing complexity of credit unions' balance sheets underscores the need for this change. Initially, the NCUA opted not to use the S component based on the relative lack of complexity in the consolidated balance sheets of credit unions. The credit union system, however, has become more complex during the last 24 years. In 1997, only 19% of a credit union's balance sheet was in mortgage-related assets. That figure has more than doubled to 45% as of the end of the second quarter of 2021, and a sizable portion of these mortgages are in fixed-rate products. Longer duration mortgage assets typically increase an institution's sensitivity to changes in interest rates and require a greater focus on liquidity risk management. By adding a market risk sensitivity component to the existing CAMEL rating system and redefining the liquidity risk component to conform to the standards used by other safety and soundness regulators, we will better protect consumers, credit unions, the Share Insurance Fund, and taxpayers. We will also implement a 2015 recommendation of the NCUA's Inspector General. What is more, time is no longer on our side. The economic fallout of the COVID-19 pandemic has led to historically low mortgage rates and a sizable refinancing wave. Consumers will likely hold on to these low-interest assets for some time, these low-interest loans for some time. However, as interest rates rise again, credit unions may find themselves in a bind in managing the changing rate environment. Separating the liquidity and market sensitivity components will help credit unions to better assess and respond to these challenges. Before closing, I do have a few questions for staff. First, at the start of the pandemic, Congress passed the CARES Act. This law made several important changes to the Central Liquidity Facility, or CLF for short. One of the substantive temporary changes allowed all 11 corporate credit unions as an agent to buy CLF capital stock for a subset of their member credit unions. Each corporate credit union determined member credit unions with assets of less than $250 million as their subset and purchased capital stock on their behalf, thus making them eligible to apply for a CLF loan if needed. The NCUA's rules and regulations do not require credit unions with less than $250 million in assets to establish a federal backup liquidity source. However, access to the CLF during times of excessive uncertainty and potential liquidity crises, such as at the start of the COVID-19 pandemic, provides credit unions and the credit union system with significant liquidity support. Tom, given that this temporary provision of the CLF is scheduled to expire at the end of 2021, do you anticipate that this will have an impact on the CAMEL's liquidity risk rating for credit unions with less than $250 million in assets?
Hello, Chairman Harper. This is Rob Bruneau, and I'll take that question. Interesting question, and a good one. Barring any significant changes in the credit union's liquidity position and risk management practices, it is unlikely that the liquidity rating would be rated any differently given the temporary membership to the CLF. If the CARES Act provision is not extended, the streamlined access to the CLF will no longer be available, will be an available source of liquidity. While any credit can join the CLF and membership is generally affordable and relatively easy, however, current creditors less than $250 million greatly benefit from the administrative and financial guidance the corporate credit agent member typically provides and avoids a 6-month wait period to receive a loan for new CLF members. While credit unions less than $250 million are not regulatorily required to have a backup federal liquidity source, in aggregate, these credit unions this size maintain ample on-balance sheet liquidity, modest loan volumes, short maturity investment portfolios, and minimal, if any, borrowing positions. However, although liquidity levels are not critical now, remaining prepared for the possibility of market liquidity constraints that could occur if the COVID-19 recovery stalls or deteriorates is a wise strategy. Should this happen, the CLF could prove vital in addressing liquidity needs for smaller to average-sized credit unions if the temporary agent membership provisions become permanent. It would be preferable that credit unions maintain access to the CLF through the agent-member relationship because it enhances both the administration and access to contingency and crisis liquidity. Thank you. That concludes my response.
Thank you, Rob. I have also heard concerns that this final rule may create difficulties for small state-chartered credit unions in the states that have not adopted the CAMEL system. Are there any implications in this final rulemaking for those institutions?
Hello, Chairman. This is Rob again.
Yeah.
Currently, there are 45 states that have federally insured state-chartered credit unions, and approximately 21 of these states do not use the S component. NCUA's adoption of CAMELs will not have any implications for these institutions. NCUA will continue to use its interest rate risk supervision program implemented in January of 2017. For smaller credit unions, examiners will generally use the automated estimated net economic value tool results to assign the interest rate risk category and rate the S component. Additionally, as mentioned in our remarks, NCUA will continue to follow its current CAMEL disclosure policy that will require NCUA examiners to disclose CAMEL's rating simultaneously with the state supervisory authorities' CAMEL disclosure to credit management and officials. Thank you. That concludes my response.
Thank you, Rob. Additionally, I know that some comment letters expressed concerns about the NCUA varying from the descriptions of the liquidity and market sensitivity risks used by the federal banking agencies. Rob or Tom, would you put this issue into context? Are the differences in the definitions of the L and S metrics really that inconsistent with other supervisors?
Thanks, Chairman. It's Tom, and I'll take that question. As I stated earlier in my remarks, I mean, we did make non-substantive, but really clarifying changes to the rating descriptions for both the S and the L components to really, essentially to enhance the differentiation between the ratings in each of those categories. However, the S and L rating descriptions remain highly consistent with the other banking agencies' UFERS and state supervisory authorities that currently use an S component. And I'll give you an example. The S-rated component rating description that the banking agencies use for the risk management concept, let's say of a 3, this is in the S now, uses a term called needs to be improved, given the size, sophistication, and level of market risk accepted by the institution. We've essentially replaced that needs to be improved with not fully commensurate with the size, sophistication of the institution, or the level of market risk that's affected. By replacing needs to be improved with not fully commensurate doesn't change the rating or the category in substance, but will provide our examiners with a more clearer way to differentiate between the ratings within each CAMEL letter. That concludes my response.
You're on mute, buddy.
Thank you, Vice Chairman Hauptman. Tom, thank you for those observations. Earlier in your answer, when you said the S and L rating components, you were referring to the sensitivity and liquidity, not the savings and loan industry. Tom, is that correct?
That's correct. Excuse me, yes, for clarifying that. And thank you.
Not a problem at all. But before recognizing others, I have just one last comment. Just as we are today separating the liquidity and market sensitivity components by adopting the CAMELS rating system, I am hopeful that we will eventually pursue a similar action for the management component of the CAMELS rating system when examining the largest credit unions. Specifically, the NCUA folds its analysis of a credit union's consumer compliance performance into the management rating component. In contrast, the federal banking agencies have created a separate consumer compliance scoring system outside of the CAMELS process. For complex credit unions, the NCUA should pursue a similar path. This system would better protect consumers and ensure that the system fulfills its statutory mission of meeting the credits and savings needs of consumers. That concludes my remarks. Vice Chairman Hauptman, you're now recognized.
Thank you, Mr. Chairman. I tell you, for the last 2 years, if I had $5 for every time I heard anyone say, "Hey, you're on mute," I would have the beach house that I'd like to have. Thank you, Tom, and your team for the presentation. The addition of sensitivity to market risk as a component to the existing CAMEL ratings should provide credit unions and provide the NCUA more transparency on interest rate risk in federally insured credit unions. Separating rate risk from liquidity risk should also make the examination process more efficient. For those reasons, I support this change. Banking regulators have done this for years, and while we don't have any obligation to follow what they do, the fact is that adding the S to CAMELS doesn't appear to have caused them trouble. I share the chairman's accolades for Mr. Hood for getting the ball rolling on this, and I thank both of my fellow board members for, earlier this year, giving more credit unions the choice to manage risk using interest rate derivatives. If we're going to discretely assess interest rate risk, it seems only fair to let people use the best tools for the job. While distinguishing between management of funds and sensitivity to interest rate risk is more precise and therefore a more desirable method for evaluating risk, I am concerned that the implementation could be disruptive, especially for credit unions with under $50 million in assets. Now, more than half of federally insured credit unions fall in this category, and as we know, they're hit hardest by even the most modest regulatory changes. And just because NCUA was already evaluating interest rate risk doesn't mean credit unions don't have extra work to do to comply with today's rule. Currently, credit unions with less than $50 million in assets are not required by regulation, Part 741, Spot 3B5, to have a separate interest rate risk policy. Therefore, examiners will not cite credit unions with less than $50 million for not having an interest rate risk policy. Credit unions do not need to do anything differently. NCUA's examination of interest rate risk will remain consistent during the transition to CAMELS. A number of credit unions have expressed concern that a separate rating for interest rate risk could impact their overall CAMELS rating. I understand that the underlying framework to assign the composite CAMELS rating is not changing, and the composite does not represent an arithmetic average of assigned component ratings. My question, and I believe the chairman already covered this, but just to be clear, let's say we add the S to CAMELS, take a credit union, leave everything exactly the same as it was. All we have done is add the S. The composite CAMELS rating is unlikely to change. Can you elaborate on that?
Hello, Vice Chair Hauptman. This is Rob Bruno again. I'd be happy to answer your question. You are correct. The framework to assign the composite CAMELS rating is not changing. The composite rating does not assume a predetermined weight for each component, nor does it represent an arithmetic average of assigned component ratings. Similarly, while the current L component considers the weights of liquidity and interest rate risks, the component rating is not an arithmetic average of the liquidity and interest rate risk assessments. Under both CAMEL and CAMELS, for most credit unions where market risk is not a significant issue, less weight should be placed on the interest rate risk or the S rating, S component, in determining a composite rating than on the other components. Conversely, for most credit unions with significant market risk issues, more weight should be placed on the interest rate or S component. For credit unions where the liquidity risk and sensitivity to market risk remain at the same levels from an exam under CAMEL, the composite CAMELS rating is highly unlikely to change due to liquidity or sensitivity to market risk. Thank you. That concludes my response.
Thank you, sir. A very thorough answer. And the rule we passed earlier this year that removed the prohibition on using interest rate derivatives for more credit unions. I know not everybody's going to use the derivatives, nor do they need to. But for some credit unions, will managing their interest rate sensitivity get a bit easier now that we've taken that action this year to allow more credit unions to use interest rate derivatives?
Vice Chair, this is Tom Fay. I'll take that question. Easier is a good question. Having the other tool was really our basic goal, to provide them with all the levers to manage IRR. So it's really up to them whether they use an on-balance sheet or an off-balance sheet mechanism to do so. That concludes my answer.
All right, thank you. That concludes all my questions. Back to the chairman.
Thank you so much, Mr. Vice Chairman. You really make a good point there on derivatives, and I also appreciated your comments about credit unions with less than $50 million in assets and how this would impact. Board Member Hood, you're now recognized.
Thank you, Mr. Chairman, and also thank you, Vice Chairman. Thank you both for just your support for today's rulemaking, and Chairman Harper for at least putting this on. It's hard to believe January seems like ages ago when we last discussed this. And thank you also to Tom and Mark and Rob for your remarks today as well. The NCUA has long considered adding S and adopting CAMELS, given that the agency revised the interest rate risk supervision implemented in 2017. Today's timing is both opportune and appropriate. I certainly believe that adapting and updating NCUA's rating system to CAMELS will help credit unions clearly understand the examiner's assessment of interest rate and liquidity risk by citing a separate S and a separate L component rating. This also has been a long and outstanding issue that has been identified by our Office of the Inspector General for quite some time now. So I'm delighted that the board can finally address this outstanding issue that has been raised, again, by our OIG. The adoption of CAMELS will not change the examination procedures for interest rate and liquidity risk assessments. Examiners will continue considering the interrelationships between and among the 7 risk categories and how they inform 6 rather than 5 CAMEL components when assigning the composite CAMELS rating. An updated rating system will also enhance the information that NCUA uses to meet our obligation to monitor critical risk areas, such as interest rate and, again, liquidity. Adopting CAMELS will strengthen our supervision and the transparency of our examination assessments, which improves NCUA's efforts to provide a safe and sound credit union system and uphold the integrity of our share insurance fund. I just have one question. The Government Accountability Office recently issued a report entitled Additional Actions Needed to Strengthen Oversight, where the CAMEL rating system at the NCUA was reviewed in detail. Can anyone please speak to this report and how we plan to address those particular findings?
This is Vicki Narwhal, and I'll try to address your question. So the Government Accountability Office examined credit union failures from 2010 through 2020, the NCUA's use of supervisory information to address deteriorating credit unions, reporting on failures, and risks facing credit unions related to the COVID-19 pandemic. The GAO report, entitled National Credit Union Administration Additional Actions Needed to Strengthen Oversight, included one recommendation related to the agency's utilization of CAMEL component and composite ratings. The specific recommendation in that report was the executive director should consider how to more fully leverage the information content from CAMEL component ratings into its composite ratings in informal and formal enforcement decisions, and update NCUA's policies and procedures as appropriate. And I'll now attempt to respond to the finding. So as part of our supervisory process, the NCUA incorporates CAMEL as specified in the National Supervision Policy Manual. CAMEL component and composite ratings are based on the descriptions and definitions established by the agency, as Rob indicated. Examiners consider the interrelationships between CAMEL components when assigning the composite rating. Additionally, we use CAMEL component ratings in some of our national and regional risk reports and as criteria for policies such as our extended examination cycle and for determining required enforcement actions. Though the absolute increases that the GAO found in the predictive value for downgrades of component ratings is relatively low, we agree to consider additional ways to extract from CAMEL component ratings any incremental information content and incorporate this into our supervisory program as appropriate. And that concludes my response, sir.
Great. Thank you, Vicki. I have no further comments. Mr. Chairman, I yield back my time.
Thank you for those insights, Board Member Hood. And if I could, for just a second, follow up on a point raised earlier by the Vice Chairman. Vicki, since we're talking about liquidity risk, could you just give us a quick reminder of what are the requirements for credit unions that are below $50 million in assets, for those between $50 and $250 million in assets, and for those above $250 million?
Vicki, I can answer that for
Thank
on
you.
behalf of the ENRE, if that's okay.
Yep.
Yeah, I mean, our regulations, and this is in Part 741, require a credit union with $50 million of assets or less to have basically what we call a policy, and which essentially documents what we call a contingency funding plan. So the contingency funding plan is a very important aspect of any credit union's liquidity risk management, because what it does is it actually describes what a credit union would need to do when its liquidity becomes under stress. So under $50 million, they need a policy that describes that. When you get over $250 million, this is where we require the federal backstop, and that's in the form of a federal discount window mechanism or a CLF membership, and therefore the contingency funding plan would be much more explicit, not just on their current liquidity risk management practices, but also what are your go-to resources for liquidity in times of stress. That concludes my remarks.
Tom, you talked about below $50 million, which they basically have to have the phone number and a policy of who they're going to call. And you talked about above 250. What about that in-between place between 50 and 250? Do they have a more specific policy?
Yeah, so in between, they have to also establish what we call a contingency funding plan that meets several of our requirements in terms of what the contingency funding plan must include. Okay, there sets out strategies for liquidity shortfalls, separate policy to incorporate asset liability management, and more importantly, a funds management policy. So you have to, it gets more explicit, more detailed when you get in between 50 and 250 million. Thank you.
Yeah. So Tom, what I'm hearing from you is we've got a scalable regulation, and would it make sense then that our examiners, as they're applying and figuring out these new liquidity and interest rate risk sensitivity, that they will be applying that scalability and then be looking at credit unions and basing their recommendations and assessment based on the size?
So yes, and what we've also done in preparation to moving toward CAMELs, because we knew L was going to be a standalone supervisory assessment, is that we have revised our examiner's guide that both rests on the regulatory requirements and provides examiners with additional information on how to assess liquidity risk. That concludes my answer.
Tom, thank you very much for those insights. Vice Chairman Hoffman, is there a motion?
Yes, sir. I move that the board approve final rule, Part 700, 701, 703, 704, and 713 of NCUA's rules and regulations, and authorize the executive director to reprogram up to $546,000 from 2021 surplus funds to complete the changes necessary to implement CAMELs as detailed in the board action memorandum.
Is there a second to the motion?
I second.
There is a sufficient second. All those in favor say aye.
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 Aye. All those opposed say nay. The ayes have it, and let the record show that the motion passed 3-0. That concludes our agenda for today, but before cavalling this meeting to a close, I, along with the other board members, would like to briefly discuss the Emergency Capital Investment Program, or ECIP, and the actions we are taking to maximize credit union participation in this very important initiative. Yesterday, the agency announced in a letter to credit unions that eligible low-income credit unions may accept 30-year subordinated debt instruments from the U.S. Department of the Treasury's ECIP. Additionally, a participating low-income credit union may treat this ECIP funding as secondary capital in accordance with NCUA's regulations, provided that any low-income credit union receiving secondary capital treatment has an NCUA-approved secondary capital plan in place by December 31st, 2021. Yesterday's announcement is part of a three-step process that the agency is taking to ensure that credit unions have full access to the Treasury Department program. The first step was a proposed rule adopted by the board on a unanimous vote in September to allow eligible credit unions to accept ECIP funding in 2022 without having to fill out a new subordinated debt application after the effective date of the new rule. We will finalize that rule later this year. The second step was yesterday's letter to credit unions allowing low-income credit unions to accept 30-year ECIP funding. And the third step will be additional NCUA action to permit ECIP funding to count as regulatory capital for the entire time that it is held. The NCUA aims to get this work done sometime in 2022. Credit unions have a statutory mission to meet the credit and savings needs of their members, including and especially those of modest means. This three-step process will allow ECIP participating credit unions to fulfill that statutory mission and advance economic equity and justice. Going forward, the NCUA will pursue additional action to permit ECIP funding to count as regulatory capital for the entire time the debt is held. I look forward to working with my fellow board members on this very important work. Vice Chairman Haltman, you are now recognized.
Thank you. All I want to say is I appreciate the quick work the staff did, and I think this is an example of the agency, that we want to be, meaning that, Treasury had this program. We took action. People reached out to us and said they'd really appreciate if we tweaked what we had already did, and we amended it, and we moved quickly and evolved, because I think that's how we want to be. We're not going to get everything 100% right all the time. Sometimes we need the input. People wanted to tweak. It was reasonable. And we made changes, and we did it quickly to solve a problem. And I think that's what we want NCUA to be. So well done to all parties. Back to you, Mr. Chairman.
Absolutely. And Board Member Hood, I know that financial inclusion is a real priority for your work. Would you like to share your thoughts on these matters?
Yes, and you're right, Chairman Harper. Financial inclusion remains a really important priority of mine simply because I believe that it's the civil rights issue of our generation. I am especially pleased and thankful for you and our staff here for the alacrity in which they were able to meet some of the tweaks that were necessary for the ECIP program to really reach its intended audience, and that is those low to moderate income communities that need investment opportunities now more than ever. I certainly hope that our stakeholders who reach out to, I'm sure all of us as board members, for me, I had a lot of dialogue with folks from the state employees credit union, not state employees, but self-help credit union, from Hope Credit Union, and also from the trade group Inclusive. It shows you all when we're able to get together in the spirit of cooperation, we are able to get things done. And again, it's those beneficiaries that now those credit unions are going to be able to use this tool, regulatory capital, and again, it's going to help them just continue that expansion of affordable access. So thank you, NCUA. Thank our board members for coming together on this today. And again, this shows that when we do hear from stakeholders, there are times when we can really act, and again, this time with great alacrity. So thank you. And I now look forward to the results.
I agree. I think the results will be really phenomenal to see where this goes over the next 30 years. And like you, I had many of those same conversations with those same organizations over the last few weeks. That is the end of today's agenda. There being no further business, we are hereby adjourned.